Hey, everybody. Welcome to the Sense of Things. And today we're going to talk a little bit about what's going on in the markets. We've got a lot of things going on in the economy. Is there going to be a recession later this year? All these things that everybody has questions about. Well, we've got answers for you today, or at least our opinion. Join Ron Lang and myself for our first episode of the Sense of Things podcast. Hey, everybody. Welcome to the new and improved Sense of Things podcast. My name is Jeff Kikel. I am your host, and my co-host is Ron Lang. Ron, how you doing, my buddy?
Good, Jeff. How are things there in Texas?
I am fantastic out here, man. We're a little bit rainy today, which we've needed. You guys have gotten more on the western part of the country than we have, so.
Yep.
So, folks, welcome to the show. This is our first show together. Ron and I have known each other for years. We met at a conference years ago, and we just purposely kind of went to the same conferences because we really hit it off. The Sense of Things podcast, we've been around for a while. My former co-host went off to some other things, and we're just going to continue on the show. Really, the format is us coming on here. Ron and I both have got 30 years at least in the investment industry. So we're going to have a lot of, our own feelings about what's going on in the markets and things like that. And that's the purpose of the show, is to share those ideas with you. So why don't we kick off? Ron, why don't you tell the audience a little bit about your background and how you got to where you're at?
Gotcha. Thanks, Jeff. I pretty much grew up in the industry. My father worked on Wall Street in the late 60s. And to tell you how geeky I became with investing during 3 summer vacations in high school, I worked on the floor of the Philadelphia Stock Exchange. So to say I grew up in it is an understatement. Started Atlas Wealth in late 2011 as an independent. And loving it ever since. Real focus is on individuals, some 401ks with small and medium-sized businesses, but the focus on long-term investing.
Nice.
How about you?
Well, for me, I didn't start off in this business. Started off actually in the advertising business after getting out of the military. And I kind of fell into the business in 1995. I just married my wife. I was working in the advertising business and traveling, and realized that everybody I worked with was divorced, and there was a reason why. And I actually liked my wife, so I ended up changing careers, and really it was to just get into the industry, actually to get another job that was local. And I fell in love with the industry. I started off with a wonderful company that I spent 17 years at, and really learn the industry. And then after that, after a couple different companies working for, I ended up going independent as well and building a wealth management practice with a friend of mine, and just recently sold my interest in that and launched what I call Freedom Day Wealth, which is really focused more on helping people reach what I call Freedom Day, the first day you woke up and you have enough assets and income to have a work optional lifestyle. Yeah. So wonderful. Well, today, folks, since it's our first show, you got to know Ron and I a little bit, but the whole purpose of this is to really share with you our feelings and beliefs on where we are in the market cycle right now. So we're going to really cover 4 things today. This is part 1 of a 2-part episode, because trying to cover everything that's going on in the markets in one episode is impossible. So today we're going to go over, where we are at in the economic cycle. We'll go over our current thoughts of where the Fed is, on interest rates, because that's the thing everybody wants to know. All my real estate investing buddies are constantly asking me this question. Portfolio strategies in the current investment environment, I think, are extremely important. And then we're going to talk a little bit about money market assets, because they're at a really unique peak. And it's an interesting story to see what the next 3 years would look like in that relation. So, Ron, why don't we kick off? where are we at in the economic cycle from your perspective?
I truly believe we're in the eighth or ninth inning before a recession. I follow a lot of smart people, certainly a lot smarter than me. And one of the big stats that I had heard for many years now is the 2-year and the 10-year Treasury inversion. Yeah. And typically when the 2-year is higher yield than the 10-year, usually you get a recession within 16 to 22 months. Yeah. Well, the yield inverted in March of last year. So we've been talking to our clients, and everything's been lining up for a recession in the second half of this year, maybe even into early 2024. I tend to question some of the analysts that I hear when they say, soft landing, no landing, all that other stuff, because everything that I've heard from all the smart people that I listen to and everything that I see, facts don't lie. And there hasn't been any time in history that so many different economic factors have lined up and we haven't had a recession. How about you? Where do you think we are?
Well, and I always laugh, everybody, the one factor that I've always used, and I tend to work from facts, but I also work from gut feeling sometimes. And anytime I hear it's different this time, it's always not been different, and it's blown up. So I'm right there with you. I mean, that's really what I've been talking with clients about is really that second half of the year. So we've been spending a little bit of time. We've carried our portfolios a little bit longer than I probably would have done before, letting them run a little bit. But we're kind of hunkering down a little bit with the clients. Getting them positioned a little bit better. Now, I think the good part is where I see things is we're kind of hopefully getting closer to the end of the interest rate raising cycle. Great. So we can actually use fixed income as a buffer now. It's been a detriment to most portfolios, and we've really had very little fixed income in our portfolios for the last year and a half.
Yeah, the interesting thing is if you just take a look at cycles, and a lot of people like to look at presidential years as far as ups and downs and everything. And, we had some very tough conversations with clients summer and fall of last year. And we were telling them 2023 is an investment year. 2024 will be a good year, and 2025 will be a great year. And trying to have conversations with people in, summer and fall of 2022 to talk about 2024, they're looking at me like, well, what do you mean? What about in the next 3 months, 6 months? And if you're a long-term investor, you gotta look past it and just keep doing consistent contributions in the high-quality positions throughout 2023, and you look like a hero in the next couple of years. But it's tough to have those conversations sometimes.
Well, but I mean, think about this last, let's say 5-6 years back. I mean, how many conversations did you hear all the pundits talking about, well, interest rates are going to go up, interest rates are going to go up. And, if you'd have bet that, I mean, you look like an idiot because, we basically had depressed interest rates for so long. I think the challenge that we faced is the central banks have just gotten so focused on basically not letting the market do its thing and kind of overwhelming the markets with central bank policy. Eventually they start going the other direction, and it starts putting, that, okay, interest rates are going up, but how far are they going to go? And what are these guys going to do? And are they going to make a mistake? Which, if you look at history, they've pretty much always made a mistake.
Absolutely. I know we're going to talk about interest rates in a minute, but, kind of going back to, the cycles. Yeah. I always said, if I ever get reincarnated, I want to come back as one of three things. I want to come back as a meteorologist, a stock analyst, right? Or an economist, because you could be wrong more than 50% of the time and still keep your job. So my point is that, the Fed, the economists, they always say they're data dependent. Well, of course, but data is lagging. Mm-hmm. So they should have started raising rates in the summer of 2021, even a quarter of a point 2 or 3 times, because by the time they got to the spring of 2022 and they realized, oh my God, It's not transitory. It got away from us. Now they try to pour cold water on it with 4 straight 75 basis point hikes, and everything reacted negatively. So what else would you expect? It's crazy. It's crazy. But look, we're going to talk about this again in 6 to 8 years with the next recession. It's just
that's exactly and we know that's going to happen. I mean, we've both been in the business long enough to know, it happens. You live through it. You plan ahead of time. You keep your powder dry. And that's really where I see us right now. We are at that 8th or 9th inning, and we've just got to start being very protective of capital at this point and be prepared for what's coming. But also be prepared for when we come out of that we can really take advantage of that upcycle.
Oh, I agree. And one of my favorite lines, and you hear this over and over and over and over again, usually more by politicians, when you get this purge with the industry and whatever, and they're like, this is the last time. It'll be different next time. I think we've seen it's not.
Yeah,
the banking crisis again, and I don't think we've seen the bottom of that yet. I know we'll talk about it in the next episode, but I still think there are more shoes to drop there.
Sure, yeah, and I mean, I think people right now, it's like, oh, well, the whole Silicon Valley Bank thing is taken care of, and Signature Bank, blah blah blah. Yeah, you're just seeing the effects, and I personally think, from an economic cycle perspective, we haven't really seen the shoes drop when it comes to corporate credit, because so many companies put on a lot of debt over the last, 5, 6, 7, 8 years with these low interest rates. And I think it's coming home to roost.
Well, not only that, but over the last week, even though I've heard about it over the last 6 to 8 months, in the last week, for whatever reason, it really surfaced was commercial property debt, because the return to the office isn't where it was pre-COVID. And now you have all of these commercial realtors with a lot of empty space. They're not getting the income, but they still have the loan obligation. So they're talking about that potentially imploding in the next 12 to 18 months because of either adjustable rates or whatever the case may be. And obviously they really can't refinance right now at higher rates. So they got quite the conundrum going, and we'll have to see how that shakes out.
Well, it's going to be interesting too, because there's an ancillary effect to that as well, that, okay, if people aren't coming back to the office, they're not going to restaurants downtown. They're not going to the shops and things like that downtown. I mean, you come from Philly. I mean, that's such hey, I work downtown. I can go over to the Penn Central Market and everything else. Well, if you don't have people coming in, it's like a ghost town during the day.
Well, Jeff, even in the suburbia area where you have office parks, complexes, and then all the supporting restaurants and other businesses around there, they're all suffering too. Yeah, it's not just the city. So I understand.
Yeah, I think it's interesting, and like I said, I think you're seeing that. I know the economic reports came out this morning, and one of the things on the economic reports was consumer. The consumer looking at Christmas time was pulling things way back. So consumer spending was significantly down, and we saw, GDP pulling back a little bit, which is good. I mean, it's less inflation, but I think the canary in the coal mine is the consumer, because we rely on it.
Well, it's a great segue, because a couple of the stats I wanted to talk about, the consumer is 2/3 of our economy. We all know that. So if the consumer isn't spending, it's going to slow. But the two interesting facts that I like to look at is right now is credit card balances and savings rate. Credit card balances are approaching an all-time high at $950 million in just credit card balances. $950 billion in credit card balances, and savings rate is at an all-time low.
Yeah.
So think about it. When we get a purge in the economy, unemployment goes up, people are out of work, those credit card balances are going to continue to go up. The savings rate will inch up a little bit, but certainly if the savings rate is down and the credit cards are up, I think there's going to be a slew of bankruptcies going into 2024, 2025.
Yeah, well, that's another stat that I heard this morning. I was just listening to the finance news, and they were talking about corporate bankruptcies are at the highest rate right now. The last, I think, 4 or 5 months, highest rate that they've been since 2008, 2009. So
it's only going to go up, and it's only going to have a cascading effect.
Yeah. So, like I said, I think we both agree we're at that economic cycle point where, okay, we're coming into, that the downside of the trough, and you just got to be careful. As we transition to the next topic about Fed's interest rates, what's your best guess at this point?
For Fed interest rates?
Yeah.
I mean, put it this way: the fact that the whole banking crisis thought the Fed was going to pause was kind of a joke. Yeah. I think they look at it as two separate things. I know I do. Mm-hmm. I think there's going to be at least one or two more hikes.
Yeah.
I don't think that the data that they're looking at regarding inflation and other things has come down enough for them to say, let's wait another month. So I think the next Fed meeting is the beginning of May. I truly believe there's at least one or two more hikes, probably at a quarter of a point each. Mm-hmm. And then I think there's a pause. One of the big things regarding the rate hikes that you kind of learn about through economists and real good analysts that I follow is that when the Fed first raises rates, it's typically a 6 to 9 month lag at the minimum, sometimes 12 months before you see the effect of that. Yeah. And I think the average person out there thinks, oh, they're raising rates. Okay, it'll have an immediate effect. It'll start. It does not happen. And just through cycles of, inflation, it takes time to get through the system. It takes time to work it out. What about you? How many more? What do you think is going to happen?
I agree with you on that point. And I mean, to your point, we're roughly 12 months from the Fed, starting that cycle last year.
So I think, right?
Yeah. So I think we're starting to feel that. And I mean, they went up really rapidly. So I think we're going to start to feel that. I agree with you. I think probably one more quarter point is about it. I mean, they went from basically 0 to 4% in no time. So I just think it's going to probably overcorrect. It's probably overcorrected at this point. I know real estate. Real estate's one of my big things. I invest, and I look on all the forums that I'm on, and it's just what's going on. How do you work in this environment with the higher interest rates and everything else? So I think it's starting to affect a lot of industries, especially the real estate industry in all different forms, whether you're in the commercial side or you're in the, you're in the residential or investment in the residential side. So, I see it from that perspective. I think they're going to have to stop here for a little bit and let it absorb a little bit in instead of just keep going. And hopefully the other side of the coin, the administration will stop trying to push money into the economy because it just counteracts everything that the Fed's trying to do.
Here I want to ask you this because a month ago, I think we both would have had a different answer.
Yeah.
Before the banking, BS in the last month, they were talking that even with there maybe 2 or 3 more hikes this year, that they would not see a reduction in rates until the middle to the end of 2024. All of a sudden, the banking situation happened, and now they're like, oh, they might start to decrease rates at the end of this year. I don't see that happening.
No.
They've got to see a precipitous fall in inflation before any reduction in rates. So I'm not even looking at that at 2024. What are your thoughts? What have you been hearing?
Well, and I mean, I think too, you're going to have to, because there's so much of their focus is on, the dual mandate. So controlling inflation, but also controlling full employment and all that. And I mean, no matter what has happened, yes, you've had some major layoffs from big employers, but, just on my own side of things, I have the space that I own here in Austin, Texas. One of the guys that works here is a recruiter for Facebook or for Meta. And he's like, man, we're still recruiting. So, you hear about these big layoffs, but in the tech industry, but what I think is going on is, okay, yeah, you might get laid off here, but then the other ones are snapping up some of these top players from their competitors. So we haven't really we've seen it in the tech industry mainly because I think they staffed up massively during the pandemic. And you haven't started to see it trickle down to the other types of businesses yet. And until that happens, the Fed's not going to change
Yeah, they definitely overstaffed in areas that didn't work out. Hence, that's why they got rid of it. But they're believe me, they're not going to get rid of top talent. I mean, they're going to keep the top talent, and certainly Google and Microsoft are going to poach as much as possible. But I think, using your cliche there, canary in the coal mine, I think we're going to know more next month in the Q1 corporate announcements, because I think we're going to see revisions down on the top line revenue, bottom line profits, and I think they're just going to put it out there. We're looking at reduction of staff. Whether or not they do or they don't, I think they want to lower the bar and lower expectations for the balance of this year to kind of recalibrate their stock price and what the analysts see, because even if there's soft or no, a recession, then they lowered the bar. But if they kept the bar where it was and above, then they're going to get smashed by analysts and by Wall Street, towards the end of this year, if the recession truly comes, and they didn't at least discuss or prepare for it.
I totally
it should
agree.
be interesting what happens in the next month here.
Yeah, and you figure we're going to have that first quarter, which it tells us really what the year is going to look like, and especially if we're leading into Q2 with some pretty ugly earnings or major revisions. I think that's going to start telling, and I agree, you're going to start seeing companies go, hey, you know what, we need to start cutting staff, in lieu of what's going on. That'll pump up their stock price. Unfortunately, it doesn't help the people that work for them, but it pumps up the stock price in most cases.
And when we start to hear major tranches of layoffs from large non-tech companies, especially manufacturers, that may be the beginning. Yeah, we'll have to see. But even so, I still look at Q3, Q4 as the recession. I think we got a head fake here in Q1 with the market because Q4 was so bad. So again, I think the next month will be very, very telling for the rest of the year. So geopolitical situation aside, I think it'll be very telling.
I think we have enough problems here alone. We don't necessarily have to, what happens outside the country, we just have to deal with, but we got enough of our own challenges. So, when you're looking at working with your clients right now, what are some of the strategies you're using to kind of adjust to where you see the market going later this year?
Well, if I asked you the same question, you'd probably start out the same way. It depends on the client. So, let's focus in on retirees, pre-retirees, and the third category, someone that's got really 10 or more years. So new clients that are coming in, even younger clients, we're doing the following short and long-term strategy. And I know we have limited time, so I'll try to keep it short. So the short-term strategy is looking at the next 6 to 9 months using a 3, 4, and 6 month laddering Treasury strategy and looking at preferred stocks right now because they're selling at a 20+% discount and they're yielding 5 to 6% or more annually. And that's dividend income, not interest income. So we want to kind of what the strategy with that short term is to park the money, hide out, preserve capital, generate some yield. And then when we start to see things bottom and stabilize Q4, Q1 into next year, leg out of that strategy and then reposition based on what their horizon line is at risk. So the short-term strategy has already started to work for us with many clients. For retirees that are very income-oriented, we may be doing a little bit of that short-term strategy depending on how much they have in their portfolio. The pre-retirees, we've had to get into that strategy because we want to protect as much of that principal as possible if they have 3 to 5 years to go before they want to retire, especially if they're inching towards that goal and haven't exceeded that goal yet as far as the amount that they need in their portfolio to generate the income they need to live off of. How about you? What have you been doing with your clients?
Well, so the way I run portfolios, I tend to run more of a sector-focused and thematic-focused portfolio. So I start with that kind of big picture, all right, asset allocation. So if you look at asset allocation for us, I'm at the lower band on most of my equity. So let's say they're a 60-40 portfolio. In most cases, I'm going to have about 50% in equity right now. But I dig, the next step down, which is thematically what's changing kind of what's that longer term focus of the markets, and then what's sectors are going to perform a little bit better. So what we've been doing is really fine-tuning portfolios to remove some of the more economically sensitive, sectors of the market. So things like banking. I mean, we've got the lowest financials we've ever had in portfolios. I've got a lot more utilities, materials, consumer staples. We're overweighting those industries, and we use sector funds to be able to do that. So we'll have a core position, and then we'll use sector funds to beef up.
The utilities are very sensitive to interest rates, so they're probably down 20-30% from last year, but you're kind of troughing right now with it. Yeah. And, what they say, you can't fall too far from a basement window. So, those utilities are probably priced very good right now with higher yields. And, as rates go down next year, they're only going to go up.
They're going to go down. And, I have the belief, people are, the last bill that they're going to continue to pay is their electrical, water, and everything else. So it's the first one that they write the check for so that they can survive. So, that's of that belief. And that, like I said, we're putting a little bit more into that right now. We've kind of rotated out of some of the techs. Definitely rotated out of finance, consumer discretionary. We've been rotating out of. So, we've made good money in those areas, and it's time to rebalance down into, like I said, less economically sensitive. Yeah, interest rate sensitive. I think we're closer to the end on that cycle, so I'm not as worried about the interest rate sensitivity.
Well, it's interesting. You're talking about, people are going to pay their electric and water bill, but that may be behind paying their Netflix and Prime subscriptions. They may be more important.
Yeah, you never know. Well, I think some people consider that a utility now. So
they may consider that the air they breathe. I get it.
Exactly. Well, I've got to have Netflix. Come on. Well, I'm going to.
Mine may be more important too. You never know. Not just the video, but for the free shipping. So
my favorite is the I'm cutting the cord, and I'm like, okay, so you're paying $60 for cable, but you're paying like $185 for all these little services that are out there.
Absolutely.
Okay, well, let's, I think that tells me a lot. I think we're on the same page when it comes to that. One of the things, and I had shared with this a little earlier with you, one of the points that I saw in a presentation recently was about money market assets being at the highest ever point in history. And what that means down the road. What's your take on that? What it's going to be for the next 3 years ish?
Well, tough to look out even past this year, but and most people don't realize this until they understand that money market rates fluctuate daily. Yeah. So I think some of them now are high twos, low mid threes, somewhere in that range. And a lot of people, the people that sit down with us on a regular basis, we can't believe how much cash they have sitting in their savings account, earning next to nothing, when they should be putting a portion or most of that either in a money market account or doing that Treasury laddering strategy that I mentioned to you to park the money for 3, 4, or 6 months if they don't need it immediately. And the one interesting thing about that is at least it's a fixed rate. So if that 4-month Treasury is getting you 4.6, 4.7, 4.8, you're going to get that annualized, obviously, where the money market may go from 3.5 to 2.8 over the next month. We all know that as interest rates will go down, so will the money market rate. So for short term, if it's money they're using or whatever, they should be putting money in that money market rate, and when they need it, move it to the checking account. Leaving it in the checking account and the savings account, it's just dead money. It's not earning you anything. And there's too many people that have too much money in that area. The other thing that I think we see, my last quick point on that is, I think that is also causing some of the issues we've seen in the banks because people are removing their deposits, putting it in the treasuries, putting it into the money market. Now the banks don't have that liquidity they need for loans and other things that they may be doing with credit lines. So I think it's kind of had a trickle effect, but the average person out there should be yielding a hell of a lot more than less than 1% if that's what they're getting on their savings. Yeah,
I mean, it's just absolutely silly. And I was working with a client in their 401k yesterday, and they had a Treasury money market in their 401k. Well, it was interesting. So they had a Treasury money market and a stable value fund, which, typically stable value funds run relatively high. The Treasury money market fund, I think, was yielding 4.3%, and the stable value fund was running 2.5.
And those stable value funds, don't forget about their fees.
Yeah.
Right? You're not getting any fees with the treasuries other than your transaction charge you get in. Yeah. So, those stable value funds haven't looked as attractive.
No, they're not as stable or as much value either way. So, well, Ron, thank you for being on the show as part of this as a co-host. I'm super excited about this. Folks, this is part 1 of a part 2. So you need to make sure that you subscribe to the channel wherever you're listening to this at, or if you're on YouTube. The show is on all the major podcast platforms and also on YouTube. So wherever you want to watch or listen to this, make sure that you subscribe to the channel and make sure you flip on the button that says, hey, remind me when there's a new show that comes out. We will be doing these on a regular basis. We're still trying to figure out our schedule with them. So the best way to do it, make sure you subscribe, make sure you check that remind me button, and we will see you guys back here.